Peter Rose, Longwood Currency Trading. It's a beautiful June morning in New Hampshire, 2021. Why do I state in so many of my videos and blog posts at longwoodcurrencytrading.com that I look at reward before I look at risk? And then I am more focused on the reward and seem to have a total disregard for my risk. So that's the thrust of the video today. I don't know how long I'm going to talk because I'd like to get out into the beauty of the nature around me. So let me show you what it's like here today because it's really pretty. Okay, so nice scenery. Is it a nice thought about disregarding your risk? All of the educational resources and the videos and everybody else talk about risk, managing the risk, risk-reward ratio, which by the way is misstated. It shouldn't be risk to reward, it should be reward to risk, so it expresses it in terms of the amount of the reward that you're looking for, not the amount of risk that you're looking for. These are just that subtle thing. When people talk about risk to reward, those words are casting more importance on the risk than they are on the reward. But there's a reason for that. Because they're afraid of losing their money. And as my karate master said, we have more of a fear of loss than we have of a want for gain. We're more afraid of stopping and going into a new restaurant to experience that than we have a want to experience the new thing. We're going to go to someplace where we're comfortable, where it's easy. And so currency trading has this enormous amount of risk to it. And so because that's prevalent on so many folks' minds, that becomes the topic of communication. The bad beats, the stop hunts, the stupidity of letting a position run, and what do you do, and how do you handle all this stuff, and there's all this weeping and gnashing of teeth over the risk. I don't worry about the risk. If I make a stupid mistake, which I do every now and then, I get my account wiped out. That's my risk. I have rules that mitigate that. So when I break a rule, I have to be willing to suffer the consequences of that. If I'm in a poker game and somebody shoves me all in and I lose, oh, what am I going to do? Wring my hands? I made the wrong decision? I made the best decision that I could based on what I knew, and it didn't work out. And so you pass that off and you wait for the next hand to be dealt. You pass off the loss and look for the next trade. When you look for the next trade, though, what are you looking for? Are you looking for risk? No. You're looking for a trade that's going to make you money. Why don't you focus on that? If I was walking down the street, would I worry about crossing the street? Would I look at both ways of the directions of crossing the street? And are there any cars coming? Is some guy on a bicycle going to run me down? Why would I do that? I have to stop every 2 feet as I was walking along the sidewalk to check the risk of crossing the road. Why would I do that? Why would I want to cross the road? Because there's a restaurant I want to go to on the other side of the street. That's my reward. I want to go in that restaurant. I want to grab dinner. Now I'm going to look at what my risk is in crossing the street. Why would you do your trading any other way? I don't understand that. You know, if this doesn't make sense to you, then don't watch any of my videos, because this is the way I think. I've done 40 years of real estate investment, okay? I've got a real good grip on how to handle this stuff. I haven't been able to manage the emotional issues and concerns of an error that I am prone to make. I'm working with that, but it's just an error. And that's going to be fixed at some point once I pull my shit together. When I follow my rules, I do really good. So let's look at those rules. Everybody has all these rules based around what they incorrectly call risk to reward. It's properly referred to as reward to risk. But so much emphasis is on the rules of risk. You got to have a 1-to-1 at least. Well, you'd like to have a 2-to-1 reward or a 3-to-1 reward for the risk that you take. What the fuck has that got to do with what price action is doing? Oh well, if I'm in a situation, then my risk is where the structural point on the graph is, or when the short MA reverses and crosses down across the long MA. I mean, those are my risk points. I gotta watch those points and well, you're just, well, what does that have to do with anything? I'm going to lose 2% of my bank. Well, so you have to, every time you're going to go into a trade, you got to look at the amount of money that you're trading with, and you're going to risk 2% of that. Well, what does the percentage of your bank have to do with how much pain you're going to take? You know, if you've got a cast iron skillet pan that you're cooking with, and you're shaking the pan by the handle, it's going to be warm because the whole thing is cast iron. Well, how much pain are you going to be willing to take before you get a pot holder? Is it 2% of your pain tolerance? No. Well, what do you do when you're going to deal with a cast iron pot? You just take a pot holder and you use it. You just, I don't care how hot the pot's going to get. This is as much heat as I'm going to let come through to my hand. Why wouldn't you manage your trades the same way? Look, life and nature, if you are, as the Buddhist would say, right thinking, right living, nature provides us all of the clues that we need in order to mitigate our risks so that we can appreciate and enjoy the bountifulness of the nature around us. But if you're constantly living in fear, how are you going to appreciate that bountifulness? They don't build boats to stay in the harbor. They build the boats to go outside the breakwater and to appreciate everything. Well, what are you going to do? You're going to sit in the harbor on the dock and make sure that the shrouds are tight and the sails are patched and all. Well, that's just common maintenance. That is risk. Either the boat is fit to go outside the breakwater or it isn't. Or you're either fit to go outside the breakwater or you're not. Yes, if you go outside the breakwater, you may get a rogue wave. 1 in 400,000 is going to be 4 times the mean. But come on, you put your life jacket on. There's certain things that we do. Driving a car, you put your seatbelt on. There's a 1 in a gazillion chance that you're going to get bumped hard enough to throw you around, but you put your seatbelt on all the time because that limits the amount that your body is going to move in a crash. If it's a really, really severe crash, maybe you'll get ripped out of that seatbelt and get thrown through the windshield. I mean, I don't know. But the seatbelt is there as a static risk management tool. The boat and the condition of the sails are static risk managements of that boat. You're not going to take a 12-foot boat out into a 35-knot wind with 2-foot seas. Just because the boat doesn't match the conditions. If you're going to take a currency trade, what are you going to do? Are you going to trade when the spread's 14 pips on a usual spread of 1.5? I mean, the majors go into 14 pip spreads on sometimes on Fridays just before the market closes, or it opens with those spreads on Sundays. You could get extreme volatility conditions or whatever, and the spread will go really wide. You know, if you're in a really long trade, the long-term trade, you don't have to worry about that because your profit targets and stops are far enough apart that the 14 pips, I hope you're not trading long-term with a 14 pip profit target, right? You should be trading for 200 pips. You don't have to worry about it. But if you're trading, you know, a day trader or a short-term swing trader over maybe a few days period of time, you know, man, you don't want to get caught in that 14 pip spread. You just don't trade. When you get that kind of extreme volatility, you don't get trade unless you're really talented in your price action judgment in order to be determined whether that volatility will move in your favor during this particular time frame, whether it's a 15-minute time frame, a 5, or you know, wherever you're at in doing it. So you're managing your risk in an active position, as opposed to, I think what I'm talking about here is the risk to reward ratio, which is done on trade entry analysis. That's the risk management I'm talking about, and the reward. I mean, once you get into the trade, you're not thinking about that initial reward. The reward is, what does the trade offer me? And that's easy to determine by some structural marks that past activity is left, and you may even take that out to support or resistance lines, which are multiple periods in the past, confirming that there's a lot of inventory at those levels that the large institutional traders are trading around. Those reward points are very easy to see. You look at the chart and you say, for my instance, I'm a day trader. I'm going to be flat at the end of the day. So I'm not going to enter a trade unless there's at least 20 or 30 pips of room for that price to go. Now, it may not get there. It may only get 10 pips. It may only get what I've got. When I put my trade on, I'm going to maybe peel a little bit off at my classic 5 pip area that I say there, and then let the rest of it run when I bring it up to I bring the trade up to break even. It may go another 5 pips. It may turn around and tap me out. It may go 10 pips. It may go the full 30 that I thought it was going to go. It may go to 100 fucking pips. You know, I'm looking at a missed opportunity in my trading right now where if I'd have been on the right side of this thing, I could have picked up 200 pips when I would normally be trading for 20. But you have to have a base reward level to even bother to look at the friggin' charts. If price is within 10 or 15 or 20 pips of a support or a major support or resistance zone or area, you're not going to want to take that trade because that support isn't just a line. There's a zone around it. It could be 10 or 15 pips either side of that line. 20 or 30 pips could be where you may have a major support zone, but you may have a lot of chatter that goes within that 15 or 20 pips, forming what they would call a flag pattern or some shit like that. pips. You wouldn't want to get into a trade when you're that close to shit. If you're down 40 pips away from that major stuff, take the trade. You can get 10 or 15 pips out of that. You know, you can make a really good living if all you did was 10 pips every time you traded. 10 pips on a $10,000 bank, you're trading a full lot. 10 pips is $100. You know, that's a pretty good thing. Some people don't make $100 a day in their work. So let's be realistic here about what that reward is that we're looking at. As long as you can be realistic about what reward level you're thinking about, then you can worry about your risk. But if you're trying to put your risk at 2% of your bank or at the next zone level where you have a resistance or collection of structure that indicates resistance levels or support zones or whatever it is that you think the price would, you know, go to if it adversely went against you or went against you adversely. What does that have to do with the reward that you're looking for? If I'm looking for a 20 pip reward, should I take a 20 pip risk? Well, why? If I'm wrong, I'm wrong. Wouldn't I want to know that I'm wrong right away? Well, how wrong do I want to be? Well, I don't really care whether it's... I don't really care, because how often have we seen 8 or 10 pip adverse movements turn to 50? Now, if that happens, it would tend to indicate that you need to work on your trade entry analysis, because you're just getting in at the wrong time. A certain percentage of the time, when you enter a trade, it'll go against you anyway. Maybe a third of the time. 2/3 of the time you get it right. You get into a trade, it'll chatter a little bit against you and then work its way up. Normal chatter. 1 ATR of chatter, maybe. Well, geez, if you're talking on a daily chart, you got 100 pips of ATR. Do you want to give your trade 100 pips of risk because you're going to go for a 300 pip profit target? I mean, that's a lot. Well, what's not a lot? 50 pips, 20 pips? We could say, well, geez, if I take a 20 pip potential loss and I'm shooting for 300 pips, that's pretty good. Yeah, but what's the likelihood you're going to get 300 pips? Maybe you get 100, only get 100 pips. Well, that's fine. You're still taking a 20 pip or 30 pip risk. Do you want to lose $200 or $300 every time you lose when you don't get the entry right? And until you become pretty adept at identifying your a good trade entry point, doesn't matter whether the thing is giving you 300 pips of a potential profit target or 30 pips of profit target. If you can't get in at the right time, you know, price is always going to go in waves. It's going to go up a little bit, it's going to come down a little bit, it's going to go up a little bit, it's going to come down a little bit for a rising price. Well, how much is it going to come down on those retracements? If you're playing the daily charts, you got a 100 pip ATR, you may get it to go up 30 or 40 pips and come down 30 or 40 pips, and then go up 50 or 60 pips and then come down 30 or 40 pips. How are you going to play that? How are you going to manage that? What if you're down playing on a 5-minute chart looking for a 30 pip profit target? What's the retraceal? What's the past price action retraceal been, even when you go successfully? Does it go up 5 or 6 pips and then come down 10? And then go up 10 or 12 and come down 10? I mean, is that retracement thing 10 points? So if it is, maybe your trade entry isn't going to work out okay if you have a short stop like I do. because you're probably going to get it wrong 60 or 70% of the time instead of getting it right 70% of the time when you become more experienced. You do the math on this. If you take a 20 pip risk to get a 50 pip gain, you're in good shape. Or let's say you're looking for, well, 20 pip gain would be 1 to 1, 2 to 1 would be 40, split the difference 30. So you're taking a 20 pip risk to make a 30 pip gain. How many times can you lose? You lose twice and win once, you're kind of screwed up. That's a 67% loss. Well, that's what you're going to lose when you start learning how to trade, for God's sakes. So you're going to lose, and you're going to lose, and you're going to lose, and you're going to lose 20 pips each time you lose. You're going to be out of runway. If you're trading a $10,000 account with $500 margin, or with a $5,000 margin, that gives you $5,000 of runway. So if you take a 20 pip loss, that's $200 at a crack. So you take 3 losses. Let's invert the if you're doing good, you get a 70% win rate. Let's invert that so that you start out with a 70% loss rate. So 7 times out of 10, you lose $200, and 3 times out of 10, you make 30. The numbers aren't going to work for you because you're too focused on how to calculate your risk. Look, if you're wrong, you're wrong. If the price is moving against you, it's going to move against you. You can't trade in a volatility situation where the price is swinging 10 or 15 pips and your profit target is 10 or 15 pips or 20 pips or 30 pips. You can't do that because the likelihood of it going through your stop it's not even jump ball, it's too high. So that's why as a day trader I'm looking for a 30 pip profit target, but I don't worry about my stop. I look at the volatility of the negative reactions that are around. That's the first thing I look at when I identify, geez, this thing has got room to run. Let's take a look at my risk. I already know what risk I'm going to take. It's 8 pips. I got a 5 pip ATR. That's the pair that I trade currently. That will change if the pair changes. That's ATR, or I go to a different pair. I just always try to be consistent in my analysis to show you what I'm doing. I trade the 5-minute chart. It's got a 5 pip ATR, and I take an 8 pip stop, hard stop. And if it goes against me, I'm wrong, and I get out. But because I have a 70% win rate, I'll take the 8 pip stop 3 times, right, for a 24 pip loss. But I'll hit say I hit 10 pips 7 times. I've made 70 pips against my 24 loss. So I'm doing really well on my analysis there. It's only if you don't understand trade entry analysis that you're going to hit the 7 losses in a row. Now you're talking about 7 times 8. You're talking about 48 pip loss and a 30 pip gain because you're winning 3 on the 10. You just can't trade like these guys on the internet and in the books are teaching you how to trade because it doesn't fucking work. And you can't trade one way when you're learning and then trade another way when you're experienced. Either learn it right to start, that's something that makes sense with somebody who knows how to teach you how to do this stuff, or don't fucking do it at all because you're just going to lose your money. If you don't lose it in the beginning, it's going to be out of luck, not skill, because you don't have any skill. So you're going to get lucky, or you're working on high leverage and you get lucky. You're working on 200 to 1 leverage or some stupid thing. If you're watching me from a country that allows that shit, don't use that leverage. God. At the most, you want a 50 to 1 leverage. Go in well capitalized. That's all I can tell you. And don't play that stupid stuff. Because even when you get experienced, listen, I can't tell you the number of traders on YouTube that claim to have made lots and lots of money. I know either because they've sort of mentioned it, or they're in a country which allowed it, or I know a trader that knows them, and they were using high leverage when they made their money. To take a $3,000 or a $10,000 account and run it to 6 figures may not be all that difficult on 200 to 1 leverage. But you got to be really, really lucky, or you got to be having somebody stand over your shoulder saying, yep, take that, take that, take that. And once you get that 6-figure account or a high 5-figure account, do you think you're going to trade that way? I don't think so. That's where all this, don't risk more than 1/4% of your account, 1-to-1 reward to risk, that's where all this shit comes from. It's useless. It doesn't make any sense. It only makes sense if you don't know what you're doing. But you have to bear in mind that you're getting this information from people who have large accounts that they're trying to protect from losing. That's not how they got the large account. Now, I'm saying many of them got it because of high leverage. Don't use high leverage thinking you're going to get to that large account, because you're going to lose. There's a 90% chance that you're going to, there's a 98% chance if you're in high leverage that you're going to lose your money. So you can't do that one. So how do you get a small account to a large account? Using 50 to 1 leverage as a max, and taking an 8-pip short stop and not compounding, and managing your trades correctly under these good guidelines. How do you get to a large account? Well, if you have, let's take my example. I lose 24 pips at the 8-pip hard stop, and I average more than the 10 pips, but let's say I get the 70 pips. So I've got 25 minus 70, I don't know what that is, 70 is 50, so 45. I got 45, close to 40, let's call it 40 pips of profit over 10 trades. So I've got 4 pips of profit every time I trade. That's how I calculate my expectation. I have a positive expectation of 4 pips. Mine is actually 8, but let's just not press it. Let's go to 5 pips, because that's, you can make a good living. If all you got was 5 pips, that's $50. $50 at the a full lot. So you might make $500 a day. Trade 10 lots. You got a $100,000 account. You make $500 a day on average when you trade. But if you're making 5 pips a trade on a 1 lot, you're making $50 when you trade. So let's say you trade 3 times a week. You're making $150 a week, right? 50 times 3. And by trading, you're over. It's got to be over the long run. I mean, these statistics are out over like 300 trades. My statistics, because I'll trade 600 times a year. You just have to wait and get your win-loss up. How do you know what your win-loss is? By winning and losing. By figuring out how to do good, correct trade entry and having a reasonable stop so that you can get that ratio right away. If you're changing your stops and and all that stuff all the time, you're never going to get a realistic win-to-loss ratio because you've got too many parameter variables going on. So if you can get that 5 pips a day and you're trading a one lot, a full lot, get 10,000 bucks in, you're making 50 bucks a day, 150 bucks a week, 600 bucks a month, right? Well, that's pretty damn good. $600 on a one lot a month, that's 6,000 bucks a year. Well, that's 60% on your $10,000 investment. What the fuck more do you want? So at the end of the year, instead of trading one lot, you could trade 1.6 lots. Or maybe halfway through, you trade a lot and a half. I don't compound on a trade-by-trade basis. I don't compound going up, and I don't reverse compound when I'm losing. I trade with that same amount of money. If I hit 8 losses in a row, if I hit 10 losses in a row, it's going to be 80 pips. That's the way it is. So whatever bank size I'm trading with, if I'm trading with a full lot, I've lost 800 bucks because I've lost 80 pips. If I'm trading 100,000, I've lost 8,000. That's what I've lost. And when I go into trade with a new account, or starting off the new year, because I always start fresh, I always assume I'm going to lose 6 times in a row at some point within the first month. So I want to know, do I have enough runway in my account to survive 6 losses in a row? And I actually prepare for 10. If I have a $10,000 account, I lose 8 pips. I lose $80 10 times. If I lose once, I lose 80 bucks, right? So I lose that 10 times in a row. That's $800. Well, I've got $10,000 account. About 5,000 or 6,000 has to go to U.S. margin. That's 5% of the current market price. These are the margin that you have to put up. So if it's $5,000 a margin, I've got $5,000 to play with. If it's $6,000 a margin, I've got $4,000 to play with. So I can withstand and if I lose 10 times in a row, an $800 or $1,000 drop in that. Now that's if I've got 5,000 a runway and I drop $1,000 right off. That's 20% of my runway, not my account. It's 5% of the account, right? So I don't worry about that. I'm prepared. I'm all set. But if I was using 2% of my bank balance as my risk, I'd have to recalculate that every time I lost. And yes, I would end up losing less in the long run, but I'd end up making less because I'm distracted, I think, by all this compounding stuff. So I have a good win-to-loss ratio because when I follow my rules, the only rule I'm following are the rules to increase the profit that I'm going to get from the trade, not the risk, because it's always going to be 8 pips. So I never have to worry about it. Here I've spent this whole freaking video talking about the money that I'm losing in comparison to that and win-loss ratios. It doesn't fucking matter. I don't even worry about my risk when I'm evaluating whether I'm going to take a trade, because my risk is 8 pips, or whatever that value is for the currency pair and the ATR that I'm trading at that particular time. It's static. I don't worry about it. I don't think about it. And that because the ATR overall doesn't change that much in relationship to time. I mean, sometimes my 5 pip ATR on the currency pair that I trade last week was 8 pips, and then it was 5 before that, and then it had spurts of 10 pips. But over the long run, an ATR is calculated over the last 14 periods. So it can jack all around. Go back and look at the ATR over the last 100 periods. It's going to be about 5 pips. So once you pick a pair and a time frame, you can pretty well factor in what that static stop level should be. If you're not comfortable with 8 pips, take 10, take 20. I don't give a shit what you do. This is what I do. Because I don't want to worry about the risk when I'm looking at my trade opportunities. I'm not thinking about it. What the fuck do I care? I know I've got, but I can say that because I've got a good win-to-loss ratio. So when you're starting out, you take those losses, but take them small until you learn. If you're going to lose 4 or 5 times in a row, you don't know what the hell you're doing. Or you're in a statistical anomaly. I'm sorry, it's not even a statistical anomaly. You're going to hit 6 losses in a row within 100 trades, 50 trades. You'll hit 13 losses. I've hit 13 losses in a row. And it wasn't when I was stupid either. It was just I hit that statistical probability. 2 of the greatest traders in the world, I forget what their names are. It's been years and years and years since I've seen them, seen the statistics on this, but I saw their equity curve charts and talked about it. And each one of them had 15 drawdowns twice in their career, 25-year careers. They had 15 losses in a row, twice. They experienced that twice in a 25-year career. So you're going to hit those. You're just going to hit them. Well, instead of farting around worrying about how much that's going to be, set it, lock it. And then you know what the worst case scenario is going to be. When I walk into a restaurant, the worst case scenario is fire breaks out. I want to know where the exit door is. I'm going to check that. So when the worst case scenario happens, I know what I got to do. By not having to concern myself with the risk level, I can therefore only have to worry about, I was going to say worry about, but I don't worry about it. I just have to look. How much is this particular price action offering me right now? Now, it's not offering me shit. Well, if price got to here, would that give me a good opportunity to get my average 25 pips that I need to go? Because I don't figure I'm ever going to get the 25 pips. I have a number that I'm going to lock to for sure if that price is running all the way up. And I know what that number is because I've done it over thousands of trades. So I know where my number is when I'm calculating my win-to-loss ratio. Let's say that number is 13. It is. And my loss is 8. I'm basically, what is that? 6 on the spread. So I'm not worried about it. If I'm going to make 13 pips 7 times and I'm going to lose 8 pips 3 times, I'm not really worried about my trade entry process. I know that I've got that down pretty good. But until you get to that point, you better be minimizing those losses So you can look at those trades after you flushed out of it and go, why did I lose 10 pips 4 times in a row? What am I doing? That's how you're going to learn. Not by reading a book or watching a video. And once you figure out, I mean, you can jumpstart that by talking to somebody who knows what they're doing and will help you with your particular trading. I mean, I've told you what I do. I look for 20 or 30 pips. And I can tell you what I do to look for it, but you wouldn't be able to duplicate it unless I was standing right next to you or in communication with you, or we were looking at a particular chart and I would say, yeah, there's 25 pips there, and you go, well, how do you see that? Because on the last chart it looked the same to me, and you didn't see that there was 25 pips. You can't describe this stuff in writing. You can't describe it by saying. That's why I never step up at the whiteboard usually, and I never show charts on my videos or in my blog posts, because you don't see the same thing I'm seeing. You're going to want to see something different. I will tell you this. In my early studying, I was looking at, everybody looks at moving average crossover systems, right? Because they just, it makes so much sense. No, it doesn't make any sense. In the long run, they lose. And I've had computer simulations show that they lose. They lose horribly. But in looking at those systems, in trying to trade against them, I eventually saw why it wasn't working, and when it didn't work, why it didn't work. You don't see that when you do computer simulations, because the simulation just tells you what the result was. It doesn't tell you why it happened. And that's really what you need to learn when you're trying to evaluate your particular position that you're looking at, to determine whether there's enough breathing room for that price to move in your favor. So it's simply a matter of convincing yourself that you're safe from a risk standpoint, so that you can relax and just look at the chart and go, yeah, that looks like it's got enough price action to move to the profit target I'm looking at. I'll take that trade. That's what you do, and that's how you do it. The only thing that takes the experience is, well, when exactly do you do that? That's a conversation for a whole other term. But to sum up here, that is all of that conversation over the last 20 minutes, or however long this thing has been going, has been to explain why I don't worry about my risk and why I focus on the reward. I hope that answers a lot of the questions that you've had for me, and if not, email me again and we'll take another run at it, okay? Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day, while I listen to this guy with his chainsaw down the road trying to clear up some firewood for next year. Have a nice day.